Okay, the first out of chapter 3, problem number 28 on page 140. And on this one, Patrick Corporation acquired 100% of O'Brien's company's outstanding common stock for $550,000 in cash. They reported net assets with a carrying value of $350,000, and there are three that were undervalued. Trademarks with a fair value of 160 and a book value of 60. Customer relations that were unbooked, unrecorded, but had a fair value of 75. And then equipment had a fair value of 312, but the book value was 342. So it's asking us to and this was on at the end of the first year. They give us financial statements, which is what is presented here. Okay, so the first thing we need to do is calculate goodwill, and let me see if I can get a. So we paid $550. This so that we can read the numbers. Okay, so we paid $550. Book value was $350. That's an excess of 200. Then we had trademarks. Make this a little bigger so you can see it. Trademarks with a fair value of 160 and a book value of 60. Relate customers. Was 75,000, and equipment had a fair value of 312, where a book value of 342. Okay, so if we take the excess and we subtract the sum of the three identified assets, we get we added that right there. Let's subtract that. We get 55,000 for goodwill. All right. Okay. So having done that, just like last week, the first thing we want to do is remove the stockholders' equity on the subsidiaries' books. So 100,000 and 392. And the offset of that goes to the investment in O'Brien, which is 492. All right, so that is stockholders' equity. Oh, hold on. Wrong one. It's stockholders' equity at the beginning of the year. 250. And that is 350,000. Okay, so that's the S entry. The A entry is increasing the trademark by 100,000. Increasing the customer relations by 75,000, and reducing by crediting the equipment by the 30,000. So that is that plus that minus that. Alright, so that's the 145. Oh, I'm sorry. And goodwill. The goodwill, which we calculated over here at 55,000. Okay. So that's the S and the A, and that's the same because it's the end of the first year of operation. So that's the same as what we had in Chapter 2. The D entry is dividends. So we had dividends paid of 222. I'm sorry, dividends declared of 80,000. And D of 80,000. And that's because under the equity method of accounting for investments, you reduce the investment account by dividends as they're declared, and you increase the investment account by income, your pro rata share, and we own 100% of O'Brien Company. So that gives us the I entry, which is income. And we recorded 210,000. And that is here, 210,000. And that brings the investment account to 0. Now the last thing is that the customer relations are assumed to have a 5-year remaining life, and the equipment is assumed to have a 10-year remaining life. So that's a net of $12,000. So the E entry is depreciation expense is going to be decreased by the 3,000. And amortization expense is going to be increased by 15,000. And the offset will be the trademark will get the credit for the amortization, and depreciation, the equipment accumulated depreciation will get the offset for the depreciation. Oh, I'm sorry, not trademarks. It's the customer relations. Gets the E entry. All right, and everything is correct.